If you've been researching ways to build or rebuild your credit, you've probably come across secured credit cards. And if you've spent any time reading online forums or Reddit threads, you might have seen people calling them scams, rip-offs, or predatory products. But here's the thing, that's not the whole story, not even close. I'm going to walk you through exactly what secured credit cards actually are, how they really work, when they're genuinely helpful, and yes, when they might not be the best choice for your situation. By the end of this video, you'll understand whether a secured credit card makes sense for your financial goals, or if there's a better path forward. This is educational content, not financial advice. Everyone's situation is different, and you should always consult with a financial professional before making major financial decisions. But first, let me tell you why this topic matters so much. Right now, millions of Americans are trying to build credit for the first time or rebuild after financial setbacks. And the advice they're getting online is often incomplete, misleading, or just plain wrong. So let's clear this up. We're going to cover what secured cards actually cost, how they compare to other credit-building options, what the credit bureaus actually see, and the specific situations where secured cards shine and where they don't. I'll also show you the fine print that credit card companies don't advertise and give you a framework for making the right choice for your situation. Let's start with the basics that most people get wrong. So what exactly is a secured credit card? And I mean really, how does it work under the hood? A secured credit card is a credit card that requires you to put down a cash deposit as collateral. That deposit typically becomes your credit limit. So if you deposit $200, you usually get a $200 credit limit. Now, here's the part that confuses people. That deposit isn't a payment. It's not a fee. It's security for the credit card company. You get it back when you close the account in good standing or when you upgrade to an unsecured card. Think of it like a security deposit on an apartment. You put money down to prove you're good for it, you use the apartment, and you get that deposit back when you move out, assuming you didn't trash the place. The credit card company holds your deposit in a separate account. You don't earn interest on it with most cards, though some do offer that. And here's the key point. You still have to make monthly payments. This is where people get confused. Your deposit is not your payment. If you charge $50 on your secured card, you owe $50 at the end of the month, just like any other credit card. Your deposit just sits there as insurance for the bank. Now, why do these cards exist? Simple. Risk management. When you apply for a regular credit card, the bank looks at your credit history. They check your credit score, your payment history, your debt-to-income ratio. They're trying to answer one question. Will this person pay us back? If you have no credit history, or if you have bad credit from past mistakes, the bank sees you as high risk. They don't have evidence that you'll pay them back, so they say no. But secured cards change the equation. With your deposit on the line, the bank's risk drops dramatically. If you don't pay, they keep your deposit. That's why secured cards are available to people with no credit or bad credit. The bank is protected. Here's a visual breakdown. Your deposit secures the line of credit, but your monthly charges require separate payments. The deposit only comes into play if you default. Now let's talk about what happens to your credit score, because this is crucial. When you use a secured credit card responsibly, it reports to the credit bureaus, Experian, Equifax, and TransUnion, exactly the same way an unsecured card does. The credit bureaus don't see a special label that says secured card. They just see a credit card account. This is important. Your credit report shows your credit limit, your balance, your payment history, and the age of the account. It doesn't distinguish between secured and unsecured. So if you make on-time payments every month, keep your balance low relative to your limit, and maintain the account responsibly, you're building real, legitimate credit history. The same credit history that helps you qualify for car loans, mortgages, better credit cards, and more. This is why secured credit cards can be powerful tools. For someone with no credit history, maybe you're 18, just starting out, or you're new to the country, A secured card can be your entry point into the credit system. For someone rebuilding after bankruptcy, foreclosure, or other financial setbacks, a secured card can be a path back to good credit. But, and this is a big but, they're not perfect for everyone. And they're definitely not free money or an instant credit score boost. Let's talk about the costs, because this is where things get interesting. Hi, I want to break down the actual costs of secured credit cards, because this is where a lot of the rip-off accusations come from. And some of them are valid, if you're not careful. Secured credit cards typically have 4 types of costs. First, the deposit itself. This usually ranges from $200 to $2,000, depending on the card. Some cards let you start with as little as $49. Remember, this isn't a fee, you get it back, but it is money you have to have up front. Second, annual fees. Many secured cards charge annual fees ranging from $0 to $95 or more. Some cards charge this fee up front, which reduces your available credit immediately. So you might deposit $200, pay a $49 annual fee, and only have $151 of available credit. That feels like a ripoff, and honestly, it kind of is. Third, interest rates. If you carry a balance month to month, you'll pay interest. Secured cards often have higher APRs than premium unsecured cards, sometimes 25 to 30%. This is where people really lose money. Fourth, other fees. Late payment fees, foreign transaction fees, balance transfer fees, cash advance fees. These add up fast if you're not careful. Here's how fees compare across popular secured cards. Notice the wide variation. Choosing the wrong card can cost you hundreds of dollars. Now, let's do some math. Let's say you choose a secured card with $300 deposit, $49 annual fee, 26% APR, $25 late fee. If you pay your balance in full every month and never pay late, your only cost is that $49 annual fee. That's about $4 per month to build credit. Not terrible. But if you carry a balance of just $150 and make minimum payments, you could pay $50 to $70 in interest over the course of a year. Add in 1 or 2 late fees, and suddenly you're paying $150 or more per year. Plus, you're still carrying debt. That's when it starts to feel like a ripoff. Compare that to some free secured cards with no annual fee, like the Discover It Secured or certain credit union options. Same credit building power, 0 annual fee. Big difference. Here's my take. Paying a reasonable annual fee, say $25 to $49, is acceptable if the card reports to all 3 bureaus, has a clear path to upgrading to unsecured, and has reasonable terms otherwise. But paying $75 to $95 annually, plus high interest because you're carrying balances, plus late fees because the payment system is confusing, that's when you're getting taken advantage of. The key is knowing what you're paying for and having a plan. Never carry a balance on a secured credit card if you can possibly avoid it. The interest rates are too high. Use it for small purchases you can pay off immediately. Now, let's talk about the alternatives, because secured cards aren't your only option for building credit. There are several other ways to build credit without putting down a deposit. First, authorized user status. If someone with good credit adds you as an authorized user on their credit card, their payment history can show up on your credit report. This is free and can boost your score quickly, but you're dependent on their good behavior, and not all cards report authorized users to all bureaus. Second, credit builder loans. These are small loans, usually $500 to $1,000, where the lender holds the money in a savings account while you make monthly payments. Once you've paid it off, you get the money. Your payments get reported to credit bureaus. Credit unions often offer these with reasonable terms. Third, becoming an authorized user on a family member's account, as I mentioned, can help, if they have excellent payment history and low utilization. Fourth, secured loans from your bank or credit union, similar to credit builder loans. Fifth, alternative credit cards that look at banking history instead of credit scores. There are newer fintech companies offering this, though it's still a developing market. Sixth, Store credit cards. Some retailers offer credit cards with easier approval standards. They usually only work at that store, but they build credit. The downside is they often have very high interest rates and low limits. Here's how these different credit-building methods stack up in terms of cost, speed of results, and accessibility. So why choose a secured card over these alternatives? Secured cards have some real advantages. 1. They're almost guaranteed approval. If you have the deposit, you'll get the card. Credit builder loans and authorized user status depend on finding someone willing to help you or having a banking relationship. 2. They function like real credit cards. You can use them anywhere credit cards are accepted. That's not true for credit builder loans, which don't give you spending power. 3. They report to all 3 major credit bureaus when you choose the right card. Not all alternatives do this. 4. They give you control. You're not dependent on someone else's financial behavior like you are with authorized user status. 5. Many have clear upgrade paths. After 6 to 12 months of on-time payments, many secured card issuers automatically review your account and upgrade you to an unsecured card, returning your deposit. The best secured cards also offer rewards. Yes, cash back on a secured card. Discover It Secured, for example, offers cash back matching in the first year. That can offset the cost entirely. But here's the critical question. When does a secured card actually make sense for you specifically? Let me hand this over to walk through the specific situations where secured cards are genuinely helpful versus where they're the wrong choice. Let's talk about real situations where secured credit cards are the right tool. Situation 1. You're building credit from scratch. Maybe you're young, you've always used debit cards and cash, and now you're trying to get an apartment or finance a car. You have no credit history. Not bad credit, just no credit. In this case, a secured card is often your fastest path forward. You can get approved within days, start making small purchases and paying them off, and within 6 months, you'll have a credit score and some history. The alternative would be waiting to find someone to add you as an authorized user or taking out a credit builder loan, which takes the same amount of time but doesn't give you the flexibility of a credit card. Cost analysis. If you choose a no annual fee secured card and never carry a balance, your cost is zero beyond the opportunity cost of having your deposit tied up. That's hard to beat. Situation 2. You're rebuilding after financial mistakes. Maybe you had medical debt that tanked your credit, or you went through bankruptcy, or you defaulted on student loans. Your credit score is in the low 500s or below 600. Traditional credit cards won't approve you. Secured cards give you a second chance. They let you demonstrate new, positive behavior. Each on-time payment helps rebuild your credit profile. The key here is making sure you've addressed the underlying issues. If you're still struggling with debt or your financial situation isn't stable, adding another credit account, even a secured one, might not be wise. Don't get a secured card if you're still drowning in debt. Situation 3. You're new to the U.S. credit system. If you're an immigrant with excellent credit history in another country, U.S. banks don't care. The U.S. credit system is separate. You're starting from zero. Secured cards are often the easiest way to establish U.S. credit history quickly. Some banks even have programs specifically for immigrants, like Bank of America and Citibank. Situation 4. You want to establish a relationship with a specific bank. Some credit unions and banks offer secured cards as a stepping stone to their full product suite. If you're planning to bank somewhere long-term, their secured card might be worth it even with an annual fee, because it can lead to better rates on car loans, mortgages, and eventually premium credit cards. Use this decision tree to evaluate whether a secured card fits your specific situation. Now let's talk about when secured cards are the wrong choice. When not to get a secured card. 1. If you can't afford the deposit without it impacting your emergency fund or basic expenses. The deposit needs to be money you can afford to have locked up for 6 to 12 months minimum. 2. If you're still struggling with overspending or managing money. Adding a credit card, any credit card, when you haven't addressed the root behavior is dangerous. You'll just end up in more debt with even worse credit. 3. If you can qualify for an unsecured card, even a basic one, why tie up a deposit if you don't have to? Even a basic unsecured card with a low limit and no rewards is better than a secured card because you keep your cash. 4. If the card has predatory terms. Some secured cards charge application fees, monthly maintenance fees, processing fees, basically fee after fee that drains your credit limit and costs you money without building credit any faster. Never pay an application fee for a secured credit card. Legitimate secured cards don't charge application fees. 5. If you're doing it just because someone told you to without understanding why. Credit building strategies should be intentional, not reactive. Let me give you a framework for making this decision. Ask yourself these questions. Can I afford the deposit comfortably? Can I commit to paying the full balance every month? Does this card report to all 3 credit bureaus? What are the total annual costs, fees plus projected interest? Is there a clear path to upgrading to unsecured? Are there better alternatives I qualify for? If you answer yes to 1, 2, 3, and 5, and the costs in question 4 are under $50 annually, and the answer to question 6 is no, then a secured card makes sense. Otherwise, you should explore alternatives or wait until your situation changes. Now here's something most people don't know about: graduation paths. Let's talk about what happens after you get a secured card, because this is where strategic thinking matters. The goal isn't to keep a secured card forever. The goal is to use it as a stepping stone to unsecured credit and better financial products. Most secured card issuers review your account every 6 to 12 months. They look at your payment history, credit utilization, and overall creditworthiness. If you've been responsible, they'll automatically upgrade you to an unsecured card and return your deposit. But there's a right way and a wrong way to use a secured card during this building period. The right way. 1. Keep utilization below 30% of your limit, ideally below 10%. If you have a $300 limit, keep your balance under $30 when the statement closes. This shows you're using credit but not depending on it. 2. Make every payment on time every single month. Set up autopay for at least the minimum payment. Payment history is 35% of your credit score. 3. Use the card regularly but for small, planned purchases. Don't let it sit unused. That doesn't build history. But don't max it out either. 4. Pay the full statement balance every month to avoid interest. This is non-negotiable if you want to avoid wasting money. 5. Monitor your credit reports quarterly. You can get free reports from all 3 bureaus at annualcreditreport.com. Make sure the secured card is reporting correctly. 6. After 6 months, check if you're eligible for credit limit increases or upgrades. Some issuers let you add to your deposit to increase your limit, which can help your utilization ratio. This timeline shows the optimal path from secured card to unsecured status with improved credit. Here's a common question. Should you get multiple secured cards or just one? Generally, start with one. Multiple hard inquiries from applications can temporarily ding your score. Plus, managing multiple new accounts when you're building credit can be overwhelming. The exception might be if you're trying to establish relationships with multiple banks or credit unions. But even then, space out the applications by at least 3 to 6 months. Another question: what happens to your deposit when you upgrade? When your secured card graduates to unsecured status, the issuer returns your deposit, usually as a check or direct deposit. This typically happens automatically after the issuer reviews your account and determines you've managed it well. Some issuers apply your deposit to your balance if you have one, which is why you should always pay in full and avoid carrying balances. Now, what if your issuer doesn't offer automatic upgrades? After 12 months of perfect payment history, you can 1. Call the issuer and request an upgrade to unsecured status. Many will review your account and grant it. 2. Apply for an unsecured card elsewhere. Once approved, close the secured card and get your deposit back. 3. Keep using the secured card if it has good terms and you're happy with it. There's no shame in keeping a secured card if it serves your needs. Let me give you realistic expectations for credit score improvement. Starting from no credit history, you can expect month 1 to 3. Credit score appears, usually 550 to 650 range. Month 6. Score climbs to 640 to 680 with perfect payment history. Month 12. Score reaches 680 to 720 plus if you've been perfect. Month 18 to 24. Score potentially 720 plus and you qualify for better products. Starting from bad credit, 500 to 580, you can expect month 1 to 3, minimal movement or slight improvement. Month 6, 20 to 40 point improvement if adding positive history. Month 12, 40 through 80 point improvement possible. Month 18 through 24 can reach 650 to 700 plus with perfect history. These are rough estimates. Everyone's situation is different based on what else is on their credit report. Real-world credit score trajectories based on different starting points and secured card usage patterns